South Korea stands as one of the world's largest holders of total reserves. Here's a graph with data we collected from the World Bank. The total reserves by country in 2023 shows that China leads the entire world with over $3.4 trillion in total reserves. They are followed by Japan with over $1.29 trillion and Switzerland at $863 billion. South Korea, however, ranks as the 9th largest holders of foreign reserves in 2023, with over $420 billion. This puts them above major economies like Singapore, Germany, France, and the United Kingdom. But how? How did South Korea emerge to become a global leader in holding foreign reserves? These very economies that we've stated, especially Germany, France, and the United Kingdom, have economies as measured by their gross domestic product are much higher than South Korea. Just take a look at this chart right here from World Bank data. It shows that Germany's GDP is over $4.4 trillion, whereas the United Kingdom with over $3.3 trillion, and France with $3 trillion. Yet, South Korea's GDP is half that of Germany's and the UK's economy, with just $1.7 trillion. So, how did South Korea become such a holder of foreign reserves? Well, before we understand the cause of this, we must first understand what a foreign reserve is. A foreign reserve is essentially a country's stash of foreign currency, gold, and other valuable assets held by its central bank. In the case of South Korea, it is held by the Bank of Korea, BOK. The BOK uses these reserves to stabilize the value of the won, South Korea's national currency, and to ensure the economy remains resilient in the face of global market fluctuations. Maintaining these high amounts of foreign reserves ensures that South Korea can counteract any sharp currency movements that could harm the country's exports or lead to financial instability. It could also help pay down foreign debt that the country may incur, and, most importantly, it helps finance the international trade of South Korea. Now that we have a clear understanding of what a foreign reserve is, let's understand how South Korea became one of the world's largest holders of foreign reserves. Here's a graph of South Korea's total reserves over the years according to the data from the World Bank. As you can see, the rise of South Korea's foreign reserves began in the late 1990s. It was a tremendous rise, especially compared to the previous decades of 1960s to 1990s. But what do you think drove this foreign reserve to rise? Well, if you take a look at the year of 1997, you see a dip right here. It was this very year that saw the start of what was known as the 1997 Asian financial crisis. It was one of the most pivotal moments in South Korea's economic history. This crisis led to major reforms for both South Korea and many Asian economies. That's because it exposed the country's financial system to many vulnerabilities. Just take a look at South Korea and a select Asian economy's GDP annual growth. You can clearly see that the Korean economy contracted over 5.1% in 1998. This contraction was the largest ever in this entire dataset from the World Bank. From the 1960s to 2023, the South Korean economy never contracted this much. Yet in 1998, it did. The results were devastating, not only to this graph, but to the entire economy of South Korea. Just take a look at the official exchange rate, period average, of the South Korean won to US dollars. You can clearly see just how much value the Korean won lost in just 1 year. 1998 was even the peak of the Korean won to the US dollar, and even today, it has never reached that high again. The impacts of a devaluing currency is, of course, devastating. To fix this, the Korean government implemented aggressive reforms that targeted the banking sector, corporate governance, and trade policies. One of the main objectives was to build a robust safety net to prevent future economic vulnerabilities, leading South Korea to prioritize the accumulation of foreign reserves. This is what led to South Korea's buildup of foreign reserves. It's the fact that the economy was scarred heavily, which led its government to build a backup plan in case something bad ever happens again. And today, just take a look at how robust the Korean economy is. Even during the COVID-19 pandemic, nor the 2008 global financial crisis, the Korean economy was always ahead compared to most major economies. This is clearly shown in their annual GDP growth. In 2009, the entire world had seen a contraction of 1.4% in annual GDP, yet South Korea saw a growth rate of over 0.8%. In 2020, the world and the United States saw a contraction of over 2.9 and 2.2%, respectively, yet South Korea only contracted by just 0.7%. One of the reasons why the economy is so robust is because of their strong foreign reserves. They can ensure that they have foreign dollars within their bank accounts and not worry about borrowing money and being highly in debt. This is an important factor to one country's economy: foreign debt. Foreign debt is, in simpler terms, the money a country borrows outside of its borders. It can be from a government itself, like, for instance, we saw several nations globally borrowing huge sums of money from China. It can also be through regional institutions like the Asian Development Bank. It can also be from the government bonds. There's lots of ways a country raises foreign debt, and the reason why they borrow money is because they often need to finance significant projects or stabilize their economies during downturns. Here's a dataset published by the Bank of Korea, which shows that back in 1997, South Korea's external debts were massive compared to their foreign reserves. This is one of the reasons that made the Korean economy vulnerable to external shocks. And as you can see ever since, the Korean economy had built up its foreign reserves and, at times, had more reserves than external debt. Recently, however, the foreign debt had again risen tremendously compared to the reserves. Despite that, the Korean economy is still in a better position than it was back in 1997. Not just because the ratio of external debt to foreign reserves is lower, but also because of its trade. Yes, trade is what we're going to discuss next. South Korea's international trade is significant. Here's a graph for the exports of goods and services since 1960. As you can see, the rise of foreign reserves in South Korea actually coincides with the rise of South Korea's exports. But what's far more important than this graph right here is a concept called current account balance. Current account balance is a measure of a country's trade flow with the rest of the world, including exports, imports, and income from abroad. When a country exports more than it imports, it has a current account surplus, meaning it brings in more foreign currency than it spends. South Korea has consistently maintained a current account surplus, thanks to its strong export sectors like electronics, automobiles, and shipbuilding. Here's a graph from the same source we continue to use. As you can see, in the 1990s, the current account balance of South Korea wasn't really doing well. It had incurred current account deficits year after year, which basically means more money was flowing out of the country through trade and income. But after the 1997 Asian financial crisis, you can see huge surpluses after surpluses every single year. At one point, the Korean economy even experienced a big current account surplus of over $105 billion in 2015. This is not only because the Korean economy had strong export sectors. Sure, it is true that they are a leader in electronics, automobiles, and shipbuilding, thanks to companies like Samsung, SK Hynix, Hyundai, and LG. But it is also important to acknowledge the government itself, as they restructured the economy to ensure that the economy is not overly reliant on debt to fuel its growth. You can see this in South Korea's fiscal policies. Fiscal policies are basically government budgets, what the government spends on their country and whether they are overspending or underspending. When a government overspends money, that typically means they are running a fiscal deficit. When they do this, they have to raise funds to cover the gap, often through borrowing or issuing government bonds. By raising funds, the government can finance necessary projects and stimulate the economy in the short term. Fortunately, the Korean government is prudent when it comes to fiscal spending. This is clearly seen in the country's low debt to GDP levels. Here's a graph of what that looks like, data from the International Monetary Fund. You can clearly see just how low the government debt to GDP of South Korea is. It is actually impressive, considering the country's developed status. Compared to other major economies, you get this. Just see how low South Korea's government debt is. It just shows how well run the Korean government is. Government debt to GDP, however, isn't a measure of just external debt to GDP. It also includes domestic debt. But having low government debt to GDP is a good indicator for their foreign reserves, because it reflects the government's ability to manage both domestic and foreign obligations responsibly. But anyway, do let us know what you think. Thanks for watching.